What if I told you the entire world nearly collapsed in 2008? Imagine waking up one morning and the world you knew, the job, the house, the security, vanished. In an instant, millions of people lost everything they had worked their entire lives for. Homes were foreclosed, families split apart, and the future suddenly seemed uncertain for all. The global economy, once a fortress of stability, crumbled. The devastation? It wasn't just a financial crisis, it was a human one. If this shocks you, hit that subscribe button. Stay with me, and I'll reveal how this silent storm almost tore us apart. The calm before the storm. In the early 2000s, everything seemed perfect. The economy was booming and people were flocking to real estate. Homes, once seen as a long-term investment, were now a ticket to easy wealth. The housing market was a gold rush and everyone was getting in on the action. Banks, eager to make a profit, started offering loans to anyone with a pulse. No questions asked. Whether you had a solid income or not, a loan was just a signature away. For a while, it worked. People bought homes they couldn't afford, but the belief in rising property values kept everyone optimistic. After all, how could the market ever go down? Enter the mortgage-backed securities, complex financial products that turned home loans into investments. Investors around the world poured money into these securities, believing they were as safe as gold. But behind the shiny promises of profit, there was a ticking time bomb waiting to go off. A perfect storm of greed, trust, and risk was building, and no one saw it coming. The foundation was cracking, and when it finally gave way, the consequences would be far-reaching and devastating. The birth of the bubble. As the housing market soared, so did the risks. Banks, eager to maximize profits, began lending money to those who should never have qualified for a loan. People with poor credit, unstable incomes, and little to no savings. These were known as subprime loans, and they were the beginning of the bubble. Lenders offered adjustable-rate mortgages, with low initial payments that would balloon into unaffordable sums once the rates adjusted. Worse, some loans didn't even require income verification, allowing anyone with a pulse to secure a home they couldn't afford. The entire system was built on the belief that real estate would never lose value. But in reality, it was all smoke and mirrors, an illusion waiting to shatter. The bubble was inflating, but no one had a clue how close they were to the burst. First signs of collapse. By 2006, the first cracks in the facade began to appear. Housing prices, which had been climbing for years, suddenly started to fall. The once booming market began to cool, and homeowners who had taken out risky subprime loans found themselves in a nightmare. Their mortgages, once manageable, became unaffordable as adjustable rates spiked. Many couldn't sell their homes for a profit, and some couldn't even sell them at all. They were stuck, trapped by loans they couldn't afford and properties worth less than what they owed. It didn't take long for the consequences to ripple through the economy. Defaults skyrocketed. Foreclosures became a common sight as banks seized homes from borrowers who had no way to pay. The housing market, once the foundation of wealth, now seemed like quicksand pulling everyone in. Meanwhile, Wall Street, which had been profiting from the very securities tied to these failing mortgages, began to panic. The complex web of investments started to unravel. The companies that had been riding high on these mortgage-backed securities began to report massive losses. What had seemed like a sure thing now appeared to be a ticking time bomb, and no one knew how big the explosion would be. Fall of the giants. The tremors of the housing collapse soon turned into a full-blown earthquake. In March 2008, Bear Stearns, one of Wall Street's oldest and most respected firms, became the first casualty. With its mortgage-backed securities in freefall, Bear Stearns couldn't survive the wave of defaults. The firm was forced into a fire sale, sold to J.P. Morgan Chase for pennies on the dollar. But that was just the beginning. A few months later, the unthinkable happened. Lehman Brothers, a 158-year-old investment bank, filed for bankruptcy. It was the largest bankruptcy in U.S. history. The impact was immediate and devastating. Investors panicked, and the global financial system, built on the back of massive debt and risky investments, began to crumble. The dominoes fell quickly. AIG, one of the largest insurance companies in the world, was on the brink of collapse. Merrill Lynch, a major player in global finance, was forced to sell itself to Bank of America. The financial world was in chaos, and the worst part? Credit froze. Banks, terrified of further losses, stopped lending to each other. Businesses couldn't borrow money. People couldn't get loans to buy homes or cars. The world's financial engine sputtered to a halt. It wasn't just the banks that were falling, it was the very foundation of global trust, the human cost. The collapse was no longer just a story for financial analysts. It was a harsh reality for millions. In the US alone, 8.7 million jobs were lost in the wake of the crisis. Once thriving industries like construction, manufacturing, and finance disappeared overnight. Families found themselves without income, scrambling to make ends meet. The American dream, which for many had once meant owning a home and providing for their children, now seemed out of reach. For countless people, the financial devastation went deeper than just losing a paycheck. Homelessness skyrocketed. Families who had once lived comfortably in suburban homes found themselves on the streets, unable to afford rent or basic necessities. Mental health problems spiked as depression set in for those who had lost everything. The stress of financial ruin led to an alarming increase in suicides. The crisis wasn't just economic, it was a profound human tragedy. The blame game. As the dust settled, the blame game began. Who was responsible for the devastation? Was it the banks, who had handed out reckless loans to unqualified borrowers? Was it the borrowers themselves, who took out mortgages they couldn't afford, believing that real estate would always appreciate? Or perhaps the regulators, who failed to monitor the financial system and allowed these dangerous practices to flourish unchecked? The truth was a mix of all these factors: greed, incompetence, and a complete lack of accountability. Banks, eager for profits, disregarded the risks and piled on the subprime loans, fueling the housing bubble. Rating agencies, meant to assess the safety of investments, gave top ratings to mortgage-backed securities that were anything but safe. Borrowers, driven by the promise of easy wealth, took out loans they didn't fully understand, trusting that the market would keep rising. Government steps in. In the face of disaster, the U.S. government intervened. In 2008, the Treasury Department passed the $700 billion bailout, known as the Troubled Asset Relief Program, TARP. The plan was simple: rescue the banks, stabilize the financial system, and prevent the collapse of the entire economy. Banks received the support they needed to stay afloat, and some even reported profits just months later. Lingering impact. In the wake of the crash, there was a push for reform. The Dodd-Frank Wall Street Reform and Consumer Protection Act was introduced in 2010, aiming to prevent another financial collapse. It brought new regulations to tighten oversight of banks and financial institutions, with the hope of preventing the reckless lending and risky investments that had led to the crisis. One of the key creations was the Consumer Financial Protection Bureau, established to protect consumers from predatory lending practices and ensure that the financial system served the people, not just the banks. Lessons we can't ignore. The 2008 financial crisis was more than just a momentary catastrophe. It was a harsh lesson in the dangers of unchecked greed. When the pursuit of profit overrides all else, the consequences can be devastating. The collapse showed that even the most stable systems could crumble when trust, accountability, and oversight are abandoned. Greed drove reckless decisions. And in the end, it wasn't just banks that suffered. It was everyday people who paid the price. Could it happen again? Nearly a decade after the 2008 collapse, one question remains: are we really safer today? While new regulations like Dodd-Frank aim to prevent another crisis, many argue that the system hasn't learned its lesson. The memory of the financial disaster is fading, and once again, risks are building up beneath the surface. Take student debt, for example. It has skyrocketed in recent years, with more than $1.7 trillion in outstanding loans. Many graduates are trapped under mountains of debt, with little hope of ever paying it off. Then there's the tech bubble, the rapid rise and potential crash of overvalued startups and companies. It's eerily similar to the housing bubble of the early 2000s. The 2008 financial crisis taught us a painful and unforgettable lesson. one that reshaped economies, upended lives, and left behind scars that still throb in the background of everyday life. It wasn't just about numbers on a screen or collapsing stock prices. It was about real people. Parents who couldn't feed their kids, workers who watched decades of savings disappear, students whose dreams were deferred indefinitely. The root cause? A toxic mix of unchecked greed, reckless decisions, and a stunning lack of accountability at the highest levels. We must remember the human cost: the jobs lost, the homes taken, the futures shattered. History has a habit of repeating itself when memory fades. So we ask the question again, not out of fear, but out of necessity. When the music stops, who pays the price? The answer should never again be the people.